Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The information provided is based on research and experience, but it should not be considered professional financial or legal advice. Auto insurance policies and state regulations can be complex and vary widely. Always consult with a qualified and licensed professional to discuss your specific situation and needs before making any insurance decisions. Did you know that the average American driver overpays for car insurance by more than $500 every single year? For many, it's over $1,000. Think about that for a second. That's a round-trip flight, a new 4K TV, a significant payment on your credit card debt, just vanishing into thin air. Why? Simply for not knowing the secrets of the insurance game. Secrets that the insurance companies are frankly not in a hurry for you to learn. Now, I want you to picture a scene that's probably all too familiar. You walk to the mailbox, you pull out the usual stack of bills and junk mail, and there it is. The envelope from your auto insurance company. It's not a friendly holiday card. It's your renewal notice. You take a deep breath and tear it open, and your stomach just drops. Your rate went up. Again. You haven't had an accident. You haven't gotten a single ticket. You're driving the same car on the same roads to the same job. So why are you being punished? It feels completely arbitrary. Like you're trapped in a system designed to slowly bleed you dry year after year. You feel powerless. Well, today that feeling ends. This video is your blueprint for taking back control. This is your escape plan from the high premium prison. I'm not just going to give you a list of websites and say good luck. That's lazy. I'm going to pull back the curtain and show you the entire machine. We are going to deconstruct the entire process piece by piece. You will learn why your rates are what they are, what the algorithms are really looking at when they generate your quote, and how to use their own system against them to get the absolute best price without ever sacrificing the critical coverage that protects you and your family. We're going to turn you from a passive customer into a savvy, informed shopper who can spot a bad deal from a mile away. This is the definitive beginner's guide to comparing auto insurance quotes online, and by the end of this journey, you'll have the confidence and the knowledge to save hundreds, maybe even thousands of dollars a year every year, for the rest of your driving life. So where do we start? We start by understanding the battlefield. Most people think insurance pricing is a simple equation. Good driver equals low rates, bad driver equals high rates. And while that's a tiny piece of the puzzle, it's like saying the Super Bowl is just about throwing a football. The reality is infinitely more complex and frankly a lot less fair than you think. Your insurance premium is not a reflection of your character or your skill behind the wheel. It is a cold, hard, calculated bet that an insurance company is making on the likelihood that you will cost them money. They call this risk, and they use a staggering amount of data to calculate it. Let's talk about the factors that actually move the needle on your premium, the ones that often have nothing to do with your driving. First, and this is a big one that makes a lot of people angry, your credit-based insurance score. Yes, in most states, the same information that determines if you get a good rate on a mortgage is also being used to price your car insurance. Insurers will tell you that their data shows a strong correlation between how a person manages their finances and how likely they are to file a claim. Whether you agree with that or not is irrelevant. It's the reality of the game. A lower credit score can signal a higher risk to the insurer, and they will charge you more for it. Sometimes a lot more. We're talking a difference of hundreds of dollars for two identical drivers who are only separated by their credit history. Next up, your zip code. You could be the safest driver in the world, with a perfect record and a brand new car loaded with safety features. But if you move one block over, into a different zip code, your insurance rate could skyrocket overnight. This isn't just about crime and theft, though that's part of it. They are analyzing mind-boggling amounts of data for that specific geographic area. What's the traffic density like? How many accidents happen per square mile? What are the weather patterns? Is your area prone to hail, flooding, or hurricanes? They even look at the rate of insurance fraud and the cost of litigation in your local court system. You are being judged and priced based on the collective behavior and environment of your neighbors. Then there's the car you drive. And again, it's deeper than you think. Everyone knows a red Ferrari is going to cost more to insure than a beige minivan. But did you know that two similar family sedans can have drastically different insurance costs? They look at the specific vehicle's claims history. How much does it typically cost to repair after a common accident? How easy is it to find parts? What's its IHS safety rating? And critically, how often is this specific make and model stolen? Your sensible, reliable Honda Accord might be a fantastic car, But if it's also the most stolen vehicle in your state, the insurance company sees it as a giant, four-wheeled target, and your premium will reflect that risk. And finally, we have to talk about the most insidious trick in the entire industry. It's a concept called the loyalty penalty. It sounds crazy, but insurance companies often give their best rates to new customers, not to the ones who have been faithfully paying their premiums for 5, 10, or even 15 years. They bank on the fact that you're busy, that shopping for insurance is a hassle, and that you probably won't bother to check if you're getting a good deal. So year after year, they perform what's called price optimization. They slowly creep your rate up, a little bit at a time, testing the limits of what you're willing to pay without complaining or leaving. It is, in effect, a tax on your loyalty. They are punishing you for your convenience. If you have been with the same insurance company for more than 2 years and haven't shopped around, you are almost certainly a victim of the loyalty penalty, and you are the person who stands to save the most money by following the steps we're about to cover. So let's recap what we've learned. Your insurance rate isn't just a number pulled from a hat. It's a complex, data-driven profile of you, your finances, your car, and even your neighborhood. It's a system designed by actuaries and data scientists to be profitable for the insurance company. They know everything about you, but now you're starting to learn about them. You understand the why behind the price. You see the invisible factors that are costing you money. This knowledge is the foundation. It's the first step to shifting the power from their hands back into yours. Because you can't win a game if you don't understand the rules. And now the rules are becoming clear. And the first rule of this game is knowing what you're actually buying. Because auto insurance isn't one single product. It's a bundle of different protections, and you get to choose which ones you want and how strong you want them to be. Think of it like building a custom suit of armor. You wouldn't just walk in and say, "Give me the standard armor." You'd want to know, is the helmet strong? Does it protect my arms? What about a meteor falling from the sky? Okay, maybe not a meteor, but you get the idea. Most people never ask these questions. They just go online, see a box that says state minimum or basic, click it and move on, proud that they found the cheapest price. This is, without a doubt, the single most expensive mistake you can make. The cheapest plan can financially ruin you. The goal isn't to find the cheapest price. It's to find the best value, the most protection for your money. To do that, you have to understand the 3 core building blocks of almost every auto insurance policy in America. These are the big 3: liability, collision, and comprehensive. Get these right and you're 90% of the way there. Let's start with the one you absolutely, positively have to have: liability coverage. This is the only part of your insurance that is legally required in nearly every state. But here's the twist that confuses everyone. Liability coverage does absolutely nothing for you or your car. Zero. It's not for you. It's for everyone else. It's your, "I'm sorry I ran into your brand new pickup truck and sent you to the hospital" fund. It pays for the damage you caused to other people's property and their medical bills if you're at fault in an accident. When you look at a quote, you'll see liability listed as a series of 3 numbers, like 25/50/25 or 50/100/50. It looks like a secret code, but it's actually simple. Let's use 25/50/25 as our example. The first number, 25, stands for $25,000. That's the maximum amount your insurance will pay for any single person's medical bills that you injure in an accident. The second number, 50, is $50,000. That's the maximum total your insurance will pay for all medical bills combined if you injure multiple people in that same accident. And the last number, 25, is $25,000 for property damage. That's the max they'll pay to repair or replace the other person's car, or their mailbox, or the fence you just drove through. Now you might be thinking, okay, my state minimum is 25/50/25, so I'm good, right? Let's play that out. You're driving on the highway, you look down at your phone for just a second, and you rear end the car in front of you. It's a brand new Tesla Model Y, a pretty common car. The rear bumper, the lift gate, the sensors, the repair estimate comes back at $32,000. Your state minimum policy covers $25,000. Who pays the other $7,000? You do. Out of your pocket. The insurance company writes their check, wishes you the best of luck, and walks away. And we haven't even talked about the driver's whiplash and the medical bills that are about to start rolling in. What if you hit a Mercedes? Or cause a multi-car pileup? State minimum liability is a financial time bomb. It leaves you shockingly exposed. One of the single best ways to protect your financial future, your savings, your home, your paycheck, is to raise these liability limits. increasing them from, say, 25/50/25 to 100/300/100 often costs just a few extra dollars a month. It is the cheapest peace of mind you will ever buy. You are not just protecting other people, you are protecting yourself from being sued into oblivion. Okay, so that's liability. Covers the other guy. But what about your car? If you have that state minimum policy and you rear-end that Tesla, your insurance pays to fix their car, but you are completely on your own for yours. Your front end is smashed, it's undrivable, and your policy does nothing. That's where the next piece of armor comes in: collision coverage. Collision is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, or even flipping your car over. If you are at fault, this is the coverage that fixes your vehicle. Now, collision coverage comes with a critical choice: your deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. They typically range from $250 to $2,000. Let's say you have a $1,000 deductible. You get into an accident and the repair bill for your car is $6,000. You pay the body shop the first $1,000, and your insurance company pays the remaining $5,000. Simple as that. The key here is the trade-off. If you choose a higher deductible, like $2,000, your monthly premium will be lower. If you choose a low deductible, like $250, your premium will be higher. This is a personal decision. The question you have to ask yourself is, how much cash could I comfortably come up with tomorrow if my car was wrecked? If a $1,000 surprise bill would be a financial crisis, you should probably opt for a lower deductible and pay a bit more each month. If you have a healthy emergency fund, you could save money on your premium by taking a higher deductible. There's no single right answer, but you need to make an intentional choice, not just accept the default option. So, liability covers them. Collision covers your car when you hit something. But what if something happens to your car that isn't a crash? What if you walk out in the morning and your car is gone? Stolen? Or a huge hailstorm dents every panel on the roof and hood? Or a deer decides to redesign your front grille on a dark country road? Or someone vandalizes it? Or it catches on fire? This is where the third foundational piece comes in: comprehensive coverage. You can think of comprehensive as the acts of God and everything else coverage. It handles damage to your car from basically anything that is not a collision. Theft, fire, flood, falling objects, animal strikes. It's the unpredictable stuff. Just like collision, comprehensive also has a deductible that you choose. And just like collision, it's usually not required by law. So, do you need collision and comprehensive? The law might not require it, but if you have a loan or a lease on your car, your bank almost certainly will. They have a financial interest in that vehicle, and they want to make sure it's protected until you pay it off. But what if you own your car outright? What if it's an older, paid-off car worth maybe $3,000 or $4,000? This is where you have to do some math. If the cost of paying for collision and comprehensive coverage for a full year, plus your deductible, is getting close to the actual cash value of your car, it might be time to consider dropping them. But you have to be brutally honest with yourself. If that car was totaled tomorrow, could you afford to go out and buy another one with cash? If the answer is no, keeping that coverage, even on an older car, might be the smarter move. These three coverages, liability, collision, and comprehensive, are the holy trinity of your auto insurance policy. They form the foundation of your financial protection on the road. Understanding what they are, how they work together, and how to set your limits and deductibles is the difference between having a policy that's a safety net versus one that's a piece of paper full of holes. You've now moved beyond the state minimum trap. You're starting to see how to build a policy that fits your life, not just the one the insurance company's website defaults to. But this is just the beginning of customizing your armor. Beyond these big three, there's a whole world of optional coverages. Things like uninsured motorist protection, medical payments, rental reimbursement, and roadside assistance. Some of these are absolute lifesavers. Others are a complete waste of money, depending on your situation. How do you know which is which? How do you avoid paying for protections you don't need, while making sure you're not leaving a critical gap in your defenses? That's exactly where we're going next. Let's crack the code. Think of your auto insurance policy not as one big, confusing document, but as a menu of different protections you can choose from. Some are required by law, some are required by your car loan, and some are just plain smart. Let's go through this menu item by item so you can build the perfect policy for you, without paying for things you don't need. First up, the absolute, non-negotiable foundation of any policy: liability coverage. This isn't for you. It's for everyone else. If you cause an accident, liability coverage pays for the damage you do to other people and their property. It's broken into two key parts: bodily injury liability and property damage liability. Let's play out a scenario. You're driving home, you glance down at your phone for just a second and boom, you rear-end the car in front of you. It's a brand new Lexus. The driver and their passenger are complaining of neck pain. This is where liability insurance becomes your financial superhero. Property damage liability will pay to repair or replace that Lexus you just hit. Bodily injury liability will pay for the medical bills, lost wages, and potentially the pain and suffering of the people in that car. Without this coverage, you would be personally on the hook for all of it. We're talking tens, even hundreds of thousands of dollars. One small mistake could wipe out your entire life savings. Now, when you look at a quote, you'll see liability limits written as 3 numbers, like 50/100/25. This looks like a secret code, but it's simple. The first number is the maximum amount. In thousands, the policy will pay for one person's injuries. So 50 means $50,000. The second number is the maximum total for all injuries in a single accident. 100 means $100,000. The third number is the maximum it will pay for property damage. 25 means $25,000. Here's the single most important piece of advice I can give you. Your state's minimum liability requirement is a trap. It is dangerously low. That $25,000 for property damage might not even be enough to replace a new Honda Civic, let alone a Lexus or a Tesla. And medical bills can skyrocket past $50,000 or $100,000 with a single surgery. Choosing state minimums is like going into a sword fight with a butter knife. You are technically armed, but you are not protected. We'll talk about how to choose the right numbers later. But for now, just know that liability coverage is what protects your entire financial future from one bad day on the road. Okay, so that covers the damage you do to others. But what about your own car? That's where the next two coverages come in, and together they're often what people call full coverage. They are collision and comprehensive. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if you collide with another object, another car, a guardrail, a telephone pole, you name it. It doesn't matter who was at fault. If you back into a pole in a parking lot, collision covers it. If you're in a 50-50 fault accident, collision covers your repairs. Comprehensive coverage, sometimes called other than collision, is for almost everything else. Think of it as the act of God or bad luck coverage. If a tree branch falls on your car during a storm, that's comprehensive. If your car is stolen, that's comprehensive. Vandalism, fire, flooding, hitting a deer, all comprehensive. For both collision and comprehensive, you have to choose a deductible. A deductible is simply the amount of money you agree to pay out of pocket before the insurance company starts paying. A common deductible is $500 or $1,000. So if you have a $1,000 deductible and you cause $5,000 in damage to your car, you pay the first $1,000, and the insurance company pays the remaining $4,000. Here's the rule. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. You're trading monthly costs for out-of-pocket risk. If you have a healthy emergency fund, a higher deductible can save you a lot of money over time. But if coming up with $1,000 on short notice would be a crisis, a lower deductible might be worth the extra cost. Do you always need collision and comprehensive? No. If you're driving a 15-year-old car that's only worth $2,000, paying for full coverage might not make sense. The cost of the coverage plus your deductible could easily be more than the car is even worth. But if you have a loan or a lease on your car, the lender will almost certainly require you to carry both. And if you have a car you couldn't afford to replace tomorrow, they are an absolute must-have. So far, we've covered other people's bodies and property, and we've covered your car. What about your body? That's where the next set of coverages comes in. First is medical payments coverage or MedPay. In some states, you'll have a more robust version called Personal Injury Protection, or PIP. The concept is similar. This coverage pays for your medical expenses and your passenger's medical expenses after an accident, regardless of who is at fault. You might be thinking, wait, I have health insurance. Why do I need this? It's a great question. MedPay can cover things your health insurance might not, like ambulance rides, dental work, or chiropractic care. More importantly, it can cover your health insurance deductible and copays. And critically, it covers your passengers who might not have health insurance of their own. It's usually a relatively inexpensive add-on that provides a fantastic layer of immediate protection. letting you get medical care right away without worrying about deductibles or fault. Next is one of the most underrated and crucial coverages you can buy: uninsured and underinsured motorist protection. Let this sink in. The Insurance Research Council estimates that 1 in 8 drivers on the road has no insurance. That's about 13% of people driving around you with zero ability to pay for the damage they cause. This coverage protects you from them. Let's say one of those uninsured drivers runs a red light and smashes into you. Your car is wrecked, and you're seriously injured. Normally, their liability insurance would pay for everything, but they don't have any. So what happens? You're stuck. Unless you have uninsured motorist coverage. It steps in and acts like the insurance the other driver should have had, paying for your medical bills and, in some states, your car repairs. Underinsured motorist coverage is similar. It protects you when the at-fault driver has insurance, but not enough. Remember that guy with the state minimum $25,000 policy? If he puts you in the hospital with $100,000 in medical bills, his insurance will pay the first $25 grand, and then he's tapped out. Your underinsured motorist coverage would then kick in to cover the remaining $75,000. It is a financial lifesaver that protects you from the irresponsible choices of others. Do not skip this. Finally, we have the optional add-ons, the little extras that can make a huge difference. There's rental reimbursement. If your car is in the shop for a week after a covered accident, this pays for a rental car. Ask yourself, could I function for a week or two without a car? If the answer is no, this coverage is cheap peace of mind. There's roadside assistance. This covers things like towing flat tires or jumping a dead battery. It's often cheaper than a separate AAA membership, but check the details. The towing distance or services might be more limited. And last, but for some people most important, gap insurance. If you have a loan on a new car, you need to listen closely. The second you drive a new car off the lot, it depreciates. It loses value. A standard insurance policy will only ever pay you what your car is worth at the moment of the crash. Its actual cash value. But you still owe the bank whatever is left on your loan. If you owe more on the loan than the car is worth, you are upside down. And there is a gap. Imagine you total a car that's worth $20,000, but you still owe $25,000 on the loan. The insurance company hands you a check for $20,000. You still have to write a check to the bank for the remaining $5,000 for a car that no longer exists. Gap insurance pays that $5,000 difference, saving you from a financial nightmare. If you put less than 20% down on a new car, or have a loan term longer than 60 months, you absolutely need gap insurance. Okay, so now you know what all these coverages are. Bodily injury, property damage, collision, comprehensive, MedPay, uninsured motorist, and all the add-ons. You can now read a quote and understand exactly what you're looking at. But the million-dollar question is, how much of each do you actually need? 100,000? A million? Is there a magic number? We're about to find out. The truth is, there is no single magic number. There's no secret formula that applies to every single person watching this. But there is a smart way to think about it, a framework that will lead you to your magic number. And it all starts by understanding the single biggest, most dangerous mistake you can make when buying car insurance. That mistake is choosing state minimum coverage. Every state has a legal minimum amount of liability insurance you have to carry to drive a car. And when you're getting quotes online, that state minimum option will almost always be the cheapest. It looks tempting. You see a low number, you think, great, I'm saving money and I'm legal. But what you're actually doing is setting a financial time bomb for yourself. Let me paint a picture for you. Let's say your state minimum for property damage is $10,000. You're driving on the highway, you glance down at your phone for just a second, and you rear-end a brand new Ford F-150. It's not a horrific crash, but you've crumpled their bumper, smashed a taillight, and bent the tailgate. The F-150 is the best-selling vehicle in America, and a new one can easily cost $60,000. The repair bill for that minor accident comes back $12,000. Your insurance pays the first $10,000, your policy limit, and then they wash their hands of it. You are now personally on the hook for the remaining $2,000. That's a bill you have to pay out of your own pocket. But that's a best-case scenario. Now imagine that same momentary distraction causes you to swerve into another lane, clipping a BMW. The BMW driver overcorrects, spins out, and hits the median. Both you, the F-150 driver, and the BMW driver are injured. The F-150 is totaled. The BMW is a $50,000 write-off. The medical bills for the other two drivers, including ambulance rides, hospital stays, and physical therapy, quickly soar past $150,000. If your state minimum liability limits are, say, 25/50/10, that's $25,000 for one person's injuries, $50,000 total for all injuries in an accident, and $10,000 for property damage, your insurance company will pay out its maximum of $60,000. But the total bill for this accident is over $250,000. That leaves a gap of nearly $200,000. And guess who they're coming after for that money? You. This is not a scare tactic. This is how the system works. They will sue you. And because you caused the accident, they will win. The court can and will order your wages to be garnished for years, maybe decades. They can put a lien on your house. They can seize your savings, your investments, anything of value. That 1 second of distraction, combined with a cheap insurance policy, has just financially crippled you for the foreseeable future. State minimum insurance isn't really insurance. It's just a piece of paper that keeps you from getting a ticket. It offers zero real-world financial protection. So, how much do you actually need? Let's start with the big one. Bodily injury liability. This is the coverage that protects you when you hurt other people. The rule of thumb here is simple and powerful. Your liability coverage should be, at a minimum, equal to your net worth. Why? Because your net worth is what you stand to lose in a lawsuit. If you own a home worth $300,000, have $100,000 in your 401k, and $20,000 in savings, your net worth is $420,000. That is the target on your back. A lawyer for an injured party will look at your assets and they will not stop until they've gotten all of it. So if you have that $420,000 net worth, but only a $100,000 liability policy, you are leaving $320,000 completely exposed. For most people, I recommend starting with limits of at least 100/300. That's 100,000 per person, 300,000 per accident. This is a solid baseline that provides a reasonable buffer for a serious, but not catastrophic accident. If you're a homeowner or have significant savings, you need to be looking at 250/500 as your absolute minimum. That's 250,000 per person, 500,000 per accident. The best part? The price jump between a terrible 25/50 policy and a respectable 100/300 policy is often just a few dollars a month. We're talking about the price of a couple of coffees for a massive increase in protection. It is the single best value in all of insurance. Next, let's talk about property damage. As we saw in our example, state minimums of $10,000 or $25,000 are a joke. The average price of a new car in the United States is now nearly $50,000. You could easily be responsible for totaling one, or even two of those cars in a single accident. Think about a chain reaction on the freeway. You hit one car, it hits another, that one hits another. You could be on the hook for all of it. For this reason, my non-negotiable, absolute bare minimum recommendation for property damage is $100,000. Again, the cost to go from $50,000 to $100,000 is usually tiny, but the peace of mind is enormous. Now, what about protecting yourself from other people? That's where uninsured and underinsured motorist coverage comes in. And this is terrifyingly important. The Insurance Research Council estimates that about 1 in 8 drivers in the U.S. has no insurance. That's over 30 million uninsured drivers on the road. In some states like Florida and Mississippi, that number is closer to 1 in 4. If one of those drivers T-bones you at an intersection and puts you in the hospital for a month, their lack of insurance becomes your problem. You have medical bills, you're losing wages because you can't work, and there's no insurance company to sue to get that money back. Unless you have uninsured motorist coverage. This coverage steps in and acts like the other driver's insurance. It pays for your medical bills, your lost wages, your pain and suffering. So how much do you need? The logic is beautifully simple. You should protect yourself just as much as you protect your assets from others. Therefore, you should always match your uninsured motorist limits to your own bodily injury liability limits. If you have 250/500 in liability, you should have 250/500 in uninsured motorist coverage. It's that simple. You are betting on yourself. For those of you who are homeowners or have a net worth of over $500,000, there's one more layer of protection you absolutely need to know about. It's called a personal umbrella policy. Think of it as a giant extra layer of liability insurance that sits on top of both your auto and your home insurance policies. Let's say you have that 250/500 auto policy, but you cause a truly horrific accident where the damages are $1 million. Your auto policy pays out its maximum of $500,000, and then your $1 million umbrella policy kicks in to cover the remaining $500,000. It's your ultimate defense against a life-altering lawsuit. And here's the kicker. A $1 million umbrella policy often costs less than $300 per year. It is the cheapest $1 million you will ever buy, and it's the key to sleeping soundly at night when you have something to lose. Finally, let's talk about protecting your own car with collision and comprehensive. The question here isn't about limits. The limit is just the value of your car. The question is about your deductible. The deductible is the amount you pay out of pocket before the insurance company pays a dime. It could be $250, $500, $1,000, or even more. The rule is simple. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. So which should you choose? The answer depends entirely on the health of your emergency fund. Ask yourself this question. If I got into an accident tomorrow, how much money could I write a check for right now without it causing a financial crisis? If your honest answer is $500, then you should not have a $1,000 deductible. Yes, you'll pay a little more each month, but you'll avoid a potential disaster where your car is wrecked, and you can't afford the deductible to get it fixed. If, on the other hand, you have a healthy emergency fund of $5,000 or $10,000 sitting in the bank, choosing a $1,000 deductible is a fantastic way to save money. You're essentially self-insuring for that first $1,000, and in exchange, the insurance company gives you a lower rate every single month. You're taking on a little more risk, but it's a risk you know you can comfortably afford. So now you know exactly what coverages to look for and how much of each you need. You're armed with the knowledge to build the perfect policy. But here's where the game really begins. Two quotes for the exact same coverage can be hundreds, even thousands of dollars apart. Why? Because of a secret list of discounts that most people don't even know exist. And in the next part, I'm going to give you that list. Alright, here it is. The ultimate checklist of auto insurance discounts. Think of this not as a list but as an arsenal. Each one is a tool you can use to systematically chip away at your premium until it's a fraction of what they first quoted you. We're going to break this down into categories so you can think like a professional insurance shopper. Let's start with the easiest category. Discounts all about you. First up, the most powerful and common one. The Good Driver discount, sometimes called the Safe Driver or Accident-Free discount. This is the insurance company's way of rewarding you for not costing them money. Typically, this kicks in after you've been accident-free and violation-free for 3 to 5 years. And it's not a tiny discount. We're talking 10 to 25% off your entire premium. This is why a single speeding ticket can be so devastatingly expensive. It's not just the $100 fine. It's the loss of this massive discount for the next 5 years, which could cost you thousands. When you get a quote, if you have a clean record, you need to make sure this discount is being applied. Sometimes it's not automatic. You have to ask. Next, for anyone in school or with kids in school, the Good Student discount. This is one of the most overlooked and most valuable discounts out there. If you or a driver on your policy is a full-time high school or college student between 16 and 25 and maintains a certain GPA, usually a B average or a 3.0, insurers will give you a major price break. We're talking up to a 25% discount. Why? Because their data shows that students who are responsible in the classroom tend to be more responsible behind the wheel. All it takes is a copy of a report card or a transcript. If you have a student on your policy and you're not getting this discount, you are throwing away hundreds of dollars a year. Period. While we're on the topic of learning, let's talk about the defensive driving course discount. You've probably seen ads for these online courses. For about $25 and a few hours of your time, you can knock 5 to 10% off your insurance bill for the next 3 years. The math on this is a no-brainer. You spend $25 once to save, let's say, $150 a year for 3 years. That's a $450 return on a $25 investment. It's one of the best financial returns you will ever find. Some states even mandate that insurers offer this. So check your state's rules, find an approved course online, and send that certificate of completion straight to your insurance company. Finally, in the About You category is the one almost everyone misses, the affiliation or group discount. Insurance companies make deals with all sorts of large organizations to offer their members a special rate. Are you a member of an alumni association? There's a discount for that. Are you a teacher, a nurse, an engineer, a first responder, or a government employee? There are discounts for that. Are you active duty military or a veteran? First of all, thank you for your service, and second, there is absolutely a huge discount for that. Think about every group you belong to. A credit union, AAA, a fraternity or sorority, even some wholesale clubs. These can save you another 5 to 15%, and they stack on top of your other discounts. Make a list of your affiliations before you start shopping. Okay, let's move on to the second category. Discounts about your SAR. The machine itself. The most obvious one is for safety features. And I don't just mean airbags. Insurers have a whole list. Anti-lock brakes or ABS. That's a discount. Daytime running lights? That's a discount. Electronic stability control? That's a discount. Many cars made in the last decade have these as standard features, but you'd be shocked how often they aren't automatically factored into your quote. You need to know what safety features your car has and make sure the insurance company knows it too. Now for a big one, anti-theft devices. If your car has anything that makes it harder to steal, the insurance company wants to reward you because it lowers their risk of having to pay out a total loss claim. This is broken into 2 tiers. Tier 1 is passive devices, things that work automatically like an engine immobilizer, which most modern keys have built right in. That can get you a nice little discount on your comprehensive coverage. But Tier 2 is where the real savings are, active devices. This means a GPS tracking system like LoJack. If your car is stolen, the device can be activated to track its location. Installing one of these can slash your comprehensive premium by as much as 20 or 25%. Also, don't forget the new car discount. If your car is less than 3 years old, you usually qualify. The logic is that new cars are more reliable, have the latest safety features, and are less likely to break down in a dangerous situation. It's a simple discount, but it can be worth 10 to 15%. And as you'd expect in today's world, there's the green vehicle discount. If you drive a hybrid or an electric vehicle, many companies will give you a little thank you in the form of a 5 to 10% discount for being eco-friendly. Now for our third category, and this is where you can get really strategic discounts about your policy and how you choose to pay. The undisputed king of all discounts is the multi-policy discount, also known as bundling. When you insure both your car and your home, or your car and your renter's insurance with the same company, they will give you a massive discount on both policies. This is the holy grail for insurance companies. They're not just insuring your car anymore. They've got you as a sticky long-term customer, and they will pay you handsomely for that loyalty. Bundling can save you anywhere from 10 to 25%. If you have renters or homeowners insurance with a different company than your auto insurance, you are almost certainly overpaying. Next is a simple but effective tactic, the pay-in-full discount. Insurance companies hate the administrative hassle of processing monthly payments. It costs them time and money, and there's always the risk you might miss a payment. So they give you a powerful incentive to pay your entire 6-month or 12-month premium all at once. By doing this, you can often save another 5 to 10%. If you have the cash available, it's like getting a guaranteed 10% return on your money for 6 months. You can't beat that in the stock market. And then there are the easy mode discounts, paperless billing and autopay. Just by agreeing to receive your documents via email instead of snail mail, and by setting up automatic payments from your bank account or credit card, you can usually shave off another 5%. It takes about 3 minutes to set up, and it saves you money forever. It is literally free money for clicking a few buttons. Okay, you've been patient. Now we get to the final category, the secret weapons. These are the discounts that can fundamentally change the game. First, let's talk about telematics, or usage-based insurance. This is the pay-as-you-drive, or pay-how-you-drive model. You agree to let the insurance company monitor your driving habits, either through a small device you plug into your car or an app on your phone. It tracks things like how many miles you drive, your speed, your braking habits, and the time of day you drive. Now, I know what you're thinking, privacy. And that's a valid concern you have to weigh for yourself. But the upside can be astronomical. If you are a genuinely safe, low-mileage driver, this is your chance to prove it. Instead of being priced based on averages for your age and zip code, you're priced on your actual driving. The initial discount for just signing up is usually around 10%. But after a few months of proving you're a safe driver, your total discount could be as high as 40%. For the right person, telematics isn't just a discount. It's a complete reevaluation of their risk, with savings to match. Finally, there's the loyalty discount. And I'm mentioning this one last for a very specific reason. Yes, if you stay with a company for several years, they will often reward you with a small loyalty discount. Feels good. It makes you feel valued. But this is also a trap. Many insurers practice something called price optimization, a fancy term for slowly raising your rates over time, year after year, hoping you won't notice. They bet that your small loyalty discount will make you feel appreciated enough not to shop around. So that 3% loyalty discount might be masking a 15% price hike they've snuck in over the last 2 years. The loyalty discount is the cheese in the mousetrap. The only loyalty you should have is to your own bank account. So there you have it. The full arsenal. We're talking about stacking a good driver discount with a good student discount with a bundling discount with an anti-theft discount with a pay-in-full discount. Suddenly, a quote that started at $200 a month is down to $90. This is how you win the game. But now a word of warning. You now have the ultimate checklist. You have more knowledge than 99% of the people getting quotes online. But having the list and knowing how to use it in the heat of the moment are two entirely different things. There is a psychological trap that 9 out of 10 people fall into on the final quote comparison page. A single button, a single default option that insurance websites use on purpose, that can trick you into overpaying by hundreds of dollars, even if you qualify for every single discount we just talked about. It preys on your assumptions and cancels out all your hard work. And that's the trap we're going to expose and teach you to avoid in the very next part. This trap has a name. I call it the apples to oranges comparison trap. And it's the single biggest reason people overpay for car insurance or, even worse, end up financially ruined after an accident. It's a subtle, brilliant deception built into the very design of online quote websites. It works by making you compare two completely different products while thinking they're the same. It's like looking at two cars. One costs $10,000, the other costs $40,000. You'd say the $10,000 car is cheaper, right? Of course. But what if I told you the $40,000 car was a brand new SUV, and the $10,000 car was a rusty lawnmower with a steering wheel glued to it? Now which one is the better value? The price tag didn't tell the whole story. That's exactly what insurance companies do. They lure you in with a shockingly low price. A price for the lawnmower policy, hoping you never bother to check what's actually under the hood. They are banking on the fact that you don't understand the 6 core components of your auto insurance policy. But that ends today. Right now, we are going to arm you with the knowledge to see right through this. This is the most important part of the entire process. Get this right and you're in control. Get this wrong and they are. Let's break it down. There are 6 key building blocks to almost every auto insurance policy. First, and most critically, is liability coverage. If you only remember one thing, remember this. Liability coverage is not for you. It does not protect your car. It does not protect your body. Liability coverage protects your money. It protects your house, your savings, your future wages from being taken in a lawsuit if you cause an accident that hurts someone else or damages their property. This is the coverage that stands between you and total financial devastation. It's always shown as 3 numbers, like 25/50/25. This is where everyone gets confused, but it's simple. The first number is the maximum amount, in thousands of dollars, the insurance will pay for any single person's medical bills if you injure them. So 25 means $25,000. The second number is the maximum total the insurance will pay for all medical bills in a single accident, no matter how many people are hurt. So 50 means $50,000 total. The third number is the maximum it will pay for all property damage you cause. So 25 means $25,000 to repair or replace the other person's car or fence or whatever you hit. Now here's the trap. Every state has a legal minimum amount of liability you must carry, and these minimums are terrifyingly low. In some states, the property damage minimum is just $5,000 or $10,000. Think about that. The average price of a new car in America is nearly $50,000. If you cause a minor fender bender with a brand new pickup truck or a Tesla, that $10,000 limit is gone in an instant. And guess who pays the rest? You do. They can sue you for it. They can garnish your wages for years. Buying state minimum liability is like trying to face a hurricane with a cocktail umbrella. It is, without a doubt, the single most dangerous financial decision a driver can make. Second and third are collision and comprehensive coverage. These are often talked about together because they both protect your car. They're simple. Collision pays to repair your car if you hit something else, another car, a pole, a wall. It's for when the accident is your fault. Comprehensive, or comp, pays for almost everything else. A tree falls on your car, hail damage, it gets stolen, you hit a deer, a rock cracks your windshield. That's comprehensive. For both of these, the key variable is your deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dime. So if you have a $500 deductible and the repair bill is $3,000, you pay the first $500, and the insurance company pays the remaining $2,500. Here's the trade-off. A higher deductible, say $1,000, means you pay less every month for your premium. A lower deductible, say $250, means your monthly bill will be higher. You're choosing between paying less now or paying less later if you have an accident. Fourth is uninsured or underinsured motorist coverage. This one is huge, and so many people skip it to save $20 a year. This is not insurance on you. This is insurance against the 1 in 8 drivers in America who are on the road right now with zero insurance. Protects you when one of them hits you. If an uninsured driver runs a red light and puts you in the hospital, their non-existent insurance isn't going to pay your medical bills. Your uninsured motorist coverage will. The underinsured part is just as important. It kicks in when the person who hits you has that cheap state minimum policy we just talked about. Their $25,000 limit won't even cover the ambulance ride and a couple of nights in the hospital these days. Your underinsured motorist coverage steps in to pay the rest, up to the limits you choose. It protects you from the irresponsibility of others. Fifth is medical payments or MedPay. In some states, this is replaced by something called personal injury protection, or PIP. They're similar. This coverage pays for your medical expenses and your passenger's medical expenses after an accident, no matter who was at fault. It's immediate. You don't have to wait for lawyers to decide who's to blame. You go to the emergency room and this coverage helps pay that bill right away. It's relatively inexpensive and incredibly valuable to have. And finally, you have the little extras like rental reimbursement and roadside assistance. Rental coverage gives you money to rent a car while yours is in the shop after a covered claim. Roadside assistance is for lockouts, flat tires, and towing. They're nice to have, but they are the lowest priority. Okay, deep breath. That was a lot, but you now understand more than 95% of drivers on the road. So let's bring it back to the apples to oranges trap. When you go to a quote website, they will often pre-fill these 6 coverages with the absolute lowest, cheapest, most dangerous state minimum levels possible. They'll set your liability to something like 25/50/10. They'll set your uninsured motorist coverage to the lowest option, or even leave it off completely. And they'll jack up your collision and comprehensive deductibles to $1,000 or even $2,000. Why? Because it generates a shockingly low price to get you hooked. You then go to a second website, and maybe this company is a little more responsible. Their default quote might start you with 50/100/50 liability and a $500 deductible. Naturally, their quote is going to be higher. You look at the two numbers side by side. Company A is $200. Company B is $400. You think, wow, Company A is a bargain. But it's not. You're not comparing apples to apples. You're comparing the price of a full-course meal to the price of a single breadstick. You're being tricked into thinking you're getting a deal, when in reality you're just buying a fraction of the protection. So how do you beat this? How do you turn the tables and force them to compete on your terms? You do it by creating your own golden standard. Before you ever type a single web address into your browser, you decide exactly what coverages you want. You create a single standardized apples-to-apples baseline that you will use for every single quote you get. You write it down. For liability, a safe and responsible starting point for most people is 100/300/100. That's 100,000 for a single person's injuries, 300,000 total for injuries, and 100,000 for property damage. For uninsured motorists, you should at least match your liability coverage. For your deductibles on collision and comprehensive, choose an amount you could comfortably pay out of pocket tomorrow without panicking. For most people, $500 is a good balanced choice. And for medical payments, $5,000 or $10,000 is a solid baseline. This is your new standard. 100/300/100 liability. 100/300/100 uninsured motorist. A $500 comprehensive deductible. A $500 collision deductible. And $5,000 in medical payments. This is your non-negotiable starting point. Every single quote you get from every single company will be for these exact same coverages. Now, and only now, can you actually compare the prices. Now you're forcing them to give you a real price for a real policy, not a phantom price for a policy that offers no real protection. You've defined the battlefield. You've set the terms of the engagement. You are now in control. You have your golden standard written down, and you're ready to finally start plugging it into the quote engines. But the moment you start, a new set of traps appears. Confusing checkboxes, optional add-ons, and subtle upsells, all designed to make you deviate from your plan and squeeze more money out of you. Navigating that final part of the quote process is the last piece of the puzzle, And it's where we're going next. You've made it through the digital interrogation. You've entered your name, your car's VIN, your driving history, your social security number, and probably the name of your first pet. You've set your liability limits, your deductibles, and now you've landed on the final page. The finish line is in sight. But this page is a minefield. It's the digital equivalent of the grocery store checkout aisle, lined with candy bars, magazines, and every little impulse buy you don't actually need. This is where insurance companies try to claw back every dollar you just saved by being a smart shopper. Let's defuse this minefield one checkbox at a time. The first things you'll see are usually labeled optional coverages or popular add-ons. The most common one is rental reimbursement. This sounds incredibly useful, right? If your car is in the shop after an accident, the insurance company pays for your rental car. And it is useful for some people. The question you have to ask yourself is, if my car is out of commission for 2 weeks, do I have another way to get to work? Do I have a spouse with a car? Can I work from home? Is public transit an option? If you're in a single-car household and you absolutely need a vehicle to function, then yes, this coverage is probably worth it. But here's the catch: they don't advertise in big, bold letters. It's not a blank check. You'll see it written as something like $40 per day, $1,200 maximum. This means they'll pay up to $40 a day for a rental, and the total they'll pay out for the entire claim is $1,200. In today's market, $40 a day might get you a compact car if you're lucky. It's certainly not going to cover the cost of renting a similar SUV or truck if that's what you're used to driving. So, you're still paying out of pocket for the difference. And that $1,200 maximum? At $40 a day, that's 30 days of coverage. If your car is in the shop for extensive repairs that take longer, you're on your own after day 30. So understand the limits. Don't just see the words rental reimbursement and click yes. Know what you're actually buying. Next on the list is usually roadside assistance or towing and labor. Again, sounds great. If you get a flat tire, run out of gas, or need a tow, you just call the number on your insurance card. The cost is usually pretty low, maybe a few dollars a month. But here is the multi-million-dollar question. Do you already have it? So many people pay for this coverage 3 or 4 times over and don't even realize it. Do you have a AAA membership? You're covered. Do you have a premium credit card, like an American Express Platinum or a Chase Sapphire Reserve? Many of them include roadside assistance as a perk. Did you buy your car new or certified pre-owned? The manufacturer often includes it for free for the first few years. Even your cell phone provider might offer it as a cheap add-on. Before you click this box, take 2 minutes to check your credit card benefits and your car's warranty information. There's no point in paying your insurance company for a service you're already getting for free somewhere else. Then we get to the heavy hitters. Gap insurance. This one is hugely important, but only for a very specific group of people. GAP stands for Guaranteed Asset Protection. Think of it this way: the moment you drive a new car off the lot, it depreciates. It's worth less than what you paid for it. At the same time, you have a loan for the full price. That creates a gap between what the car is worth and what you owe on it. Now, imagine you total that car 6 months later. Your comprehensive coverage will pay you what the car is worth at the time of the accident. It's depreciated value. But you still have to pay the bank what you owe on the loan. If you owe $25,000, but the car is only worth $22,000, you are on the hook for that $3,000 difference. You'll be writing a check for $3,000 for a car that is now a heap of scrap metal. Gap insurance pays that difference. So who needs it? You need it if you put a small down payment on a new car, or if you rolled negative equity from a previous car into your new loan. You also need it if you have a long loan term like 72 or 84 months, because you'll be upside down for a much longer time. The key is you don't need it forever. Once you've paid down your loan to the point where you owe less than the car is worth, you can call your insurer and cancel it. Don't keep paying for it for the entire life of the loan. And for those of you with custom rims, a booming sound system, or a custom paint job, you'll see an option for custom parts and equipment coverage. This is non-negotiable if you've modified your car. Your standard collision and comprehensive policies will only pay to replace your car with factory equivalent parts. If your $2,500 wheels get destroyed in a crash, your insurance will give you the value of the boring stock steel wheels that came with the car. This add-on covers the real value of your upgrades. If you've invested in your vehicle, you need to protect that investment. Now we move from the optional coverages to the psychological traps. You'll see things that sound amazing, like accident forgiveness. Wow, they'll forgive my first at-fault accident? My rates won't go up? Sign me up. Not so fast. Accident forgiveness isn't a gift. It's a product you pay for. You are literally prepaying for a potential future mistake. The cost is baked into your premium, meaning you're paying more right now on the chance you'll cause an accident later. And there are always strings attached. Usually you have to be a customer with that specific company accident-free for a certain number of years, often 3 to 5, before the forgiveness even kicks in. It's a loyalty program disguised as a benefit. It's designed to keep you from shopping around because you don't want to lose your status. For most safe drivers, it's a waste of money. You're better off paying the lower premium now and dealing with a potential rate increase if an accident ever happens. Then there's the final section of the page, often with boxes already checked for you. This is where they try to lock you into payment methods that benefit them. You'll see a choice between pay in full for the 6-month term or easy monthly payments. The monthly option looks tempting. It breaks that big $600 number down into $100 a month. What they hide in the fine print is that the easy monthly payments come with installment fees, service fees, or whatever they decide to call them. It can be anywhere from $5 to $15 per payment. A $10 fee every month on a 6-month policy is an extra $60. You just gave back that discount you fought so hard for. If you can afford it, always choose the paid in full option. It's the single biggest and easiest discount you can get. Think of it as earning a guaranteed 5 to 10% return on your money in just 6 months. The stock market can't even promise you that. They will also aggressively push you to sign up for EFT or electronic funds transfer, where they automatically pull the money from your bank account. They'll even offer a small discount for it. They aren't doing this just for your convenience. They're doing it because it dramatically increases the chance you'll renew with them without shopping around. When the renewal comes up, the money just keeps flowing out of your account. It's automatic. It reduces their churn rate and locks you in. If you do choose it for the discount, that's fine, but mark your calendar for 5 months from now. Set a reminder on your phone. You have to be proactive about shopping for your renewal, because they are counting on you to forget. So, when you land on this final chaotic page, take a breath. Your strategy is simple. First, uncheck every single box they have pre-selected for you. Start with a clean slate. Then go down the list one by one and deliberately ask yourself, based on my specific situation, do I truly need this? Do I need rental coverage? Or do I have a backup plan? Do I already have roadside assistance from another source? Am I upside down on my car loan and need GAP? Have I customized my car? And finally, am I able to pay in full to avoid their monthly fees? By making these conscious choices instead of just accepting the default, you are crafting a policy that is tailored to you, not to their profit margin. You've taken control. You've built your perfect quote from one company, a true, honest price for the exact coverage you need. But a single data point is not a comparison. The real power comes when you take this number and put it head-to-head against its competitors. The question is, how do you manage all this information from multiple sites without getting completely overwhelmed? How do you organize it so you can see in a single glance who is truly offering the best deal? That requires a system, a blueprint for comparison. And building that blueprint is exactly what we're going to do next. Alright, let's build your command center. This isn't just about making a list. It's about creating a powerful comparison matrix. A tool that takes all those jumbled numbers and confusing terms from different companies and lays them out with military precision. This is how you go from being a consumer to being the commander of your own financial decisions. You don't need fancy software. All you need is a simple spreadsheet, Google Sheets, Microsoft Excel, whatever you've got. If you're old school, a piece of paper and a ruler will work just fine. We're going to create columns, and each column will represent a critical piece of intelligence. Your first column on the far left is the simplest carrier name. This is where you'll list each contender. Progressive, Geico, State Farm, a smaller local company, each one gets its own row. The next column is the one everyone jumps to first, the 6-month premium. This is the big, flashy number they put at the top of the quote. Write it down big and clear. This is our baseline, but I promise you it is far from the whole story. Right next to that, create a third column, monthly cost. Simply take the 6-month premium and divide it by 6. Why? Psychology. Seeing a difference of $120 over 6 months feels abstract. Seeing that one policy is $20 more per month feels real. It's the cost of a few cups of coffee. This simple calculation reframes the cost in terms you deal with every single day, making the comparison much more intuitive. Now we get to the heart of the policy. The next 3 columns are your non-negotiables. These are the columns that must be identical across every single row for this comparison to be valid. This is the apples to apples score. Column 4. Bodily injury liability per person. Column 5. Bodily injury liability per accident. And column 6. Property damage liability. Look at your quotes. If you ask for 100/300/100, you need to verify that every single quote came back with those exact numbers. You will be shocked at how often an online system might default you to a lower state minimum, or an agent might quote you something different to make their price look more attractive. If a quote doesn't match your requested liability limits, you either need to get a corrected quote, or you cross that row off your list entirely. It's a false comparison. It's like comparing the price of a V8 Mustang to a 4-cylinder model. They are not the same car. Okay, liability is locked in. Now let's protect your own vehicle. The next 2 columns are your personal shield. Column 7. Collision deductible. Was it $500? $1,000? Write it down. Column 8. Comprehensive deductible. Same thing. Was it $500? $1,000? Maybe even $250? Note it. This is the second critical apples to apples checkpoint. A company can easily make their premium look $10 cheaper per month by quoting you a $1,000 deductible when everyone else quoted you for $500. That's not a better deal. That's just a different, riskier policy. You are paying less because you are agreeing to pay more out of your own pocket if you have a claim. Make sure the deductibles in your matrix are identical for each carrier you're seriously considering. We're building a powerful picture now. But we're not done. What about the other driver who has no insurance? Column 9. Uninsured/underinsured motorist coverage. Write down the limits just like you did for your own liability. For example, 100/300. Again, this needs to be a consistent number across the board for a fair fight. Now we move from the core coverage to the bells and whistles. This is where the sneaky differences often hide. Column 10. Add-ons. This column is more of a checklist. Does the quote include roadside assistance, rental car reimbursement, medical payments, or personal injury protection? Instead of a number, you can just use a yes or no. Or note the daily rental limit, like $30 per day. One company might have a slightly higher premium, but includes a top-tier roadside assistance package for free, while the cheaper quote charges an extra $8 a month for it. Without this column, you'd never spot that. You just see the cheaper price and assume it's the better value. We're getting close to the finish line. Let's talk about the reason for the price, the discounts. Column 11. Key discounts applied. Don't list every single one. Just look for the big ones. Did they apply the multi-policy discount for bundling home or renters? Did they give you the good driver discount? The good student discount? The paid in full discount? This column is your troubleshooting tool. If one quote is way higher than the others, a quick glance here might reveal they forgot to apply your multi-policy discount. You can then call them, get it corrected, and potentially see that price drop dramatically. It's your quality control check. Finally, the last column. And in my opinion, this might be the most important one on the entire sheet. It's the one that separates a spreadsheet from a true decision-making tool. Column 12. The human factor. This is a notes column. Here, you're going to step away from the quote itself for just 2 minutes. Open a new browser tab and search for Carrier Name Claim Satisfaction Reviews or Carrier Name Customer Service Reviews. You're not doing a deep dive investigation. You're just getting a gut check. Are the results from sources like J.D. Power or the Better Business Bureau generally positive, average, or a complete nightmare? In this column, write a single word: excellent, good, average, or poor. Now step back and look at your creation. It's no longer a confusing pile of PDFs and emails. It's a clean grid, a dashboard. You can see Progressive 6-month premium, $750. Monthly, $125. All coverages match your 100/300/100 spec. Deductibles are $500. It includes rental reimbursement. All key discounts are applied. And your human factor note says good. On the next row, you have Bargain Insurance Incorporated. 6-month premium, $600. Monthly, $100. Looks amazing, right? But you look across the row. They quoted you on state minimum liability, not the 100/300/100 you asked for. The collision deductible is $1,000, not $500. It has no add-ons. And your human factor note says poor, with reviews mentioning nightmare claims processes. This is clarity. This is power. The $25 a month you'd save with Bargain Insurance Incorporated isn't a saving at all. It's the price you're paying for a vastly inferior product and a potential future headache. The Matrix reveals the truth behind the price tag. It transforms you from a price shopper into a value investor. You've built the blueprint. You've gathered the intelligence and organized it. You can now see with cold, hard clarity how each company stacks up on the things that actually matter. The fog of confusion has lifted. But now comes the final step. With this perfect logical grid in front of you, how do you make the final choice? Because sometimes 2 or 3 options look really good. How do you read between the lines of this data to spot the hidden traps and truly identify the single best option for you? That's about moving from analysis to decision. And that final strategic move is what we're going to break down next. Alright, you've done the heavy lifting. You've gathered the quotes. You're probably looking at a spreadsheet or a list with 5, maybe 10 different insurance companies, each with a different price tag. Some are shockingly cheap, others are comfortably in the middle, and a few are just way out there. And if you stopped right here and just picked the cheapest one, you'd be making the single biggest mistake in the entire process. Because that list of numbers? That's not the finish line. That's the starting line for the final, most important analysis. This is where you separate the good deals from the good-looking traps. The first thing we need to do is look past the price and scrutinize the company itself. Think of it this way. An insurance policy is just a promise. It's a promise that if something terrible happens, a company you've never met will show up with a very large check to make you whole again. So, the most important question is, how good is their promise? A cheap promise that never gets kept is worthless. So, how do you judge a company's character from your computer screen? You become a detective. Your first stop is J.D. Power. These guys are the gold standard for unbiased customer satisfaction ratings in the auto industry. They survey thousands and thousands of real customers and rank insurance companies on everything from the initial purchase experience to, most critically, how they handle claims. Don't just look at the overall score. Dig into the claim satisfaction rating. This is the moment of truth. A company can have a slick website and friendly sales agents, but if their claims department is a nightmare to deal with when you're already stressed from an accident, that low premium you were so proud of will feel like a cruel joke. Are they in the top tier? Average? Or are they languishing at the bottom? If a company on your list has a rock-bottom claim satisfaction score, I don't care if they're offering to pay you to take their policy, put a big red line through them. It's a risk not worth taking. Next, you need to check their financial health. This sounds complicated, but it's simple and it's crucial. You're looking for something called an AM, best rating. This isn't about customer service. It's about financial stability. It's a grade from a plus all the way down to D that tells you if the insurance company has the actual cash on hand to pay out all its claims, even in a major catastrophe like a hurricane that damages thousands of cars at once. You want a company with a rating of A or better. Why? Because if you get into a major accident and the at-fault driver's cheap, unrated insurance company goes bankrupt, you could be left fighting for scraps in court. And if your own insurance company goes under, your coverage could vanish overnight. It's rare, but it happens. Think of it as a credit score for the insurer. You wouldn't lend a huge amount of money to someone with a terrible credit score. So why would you trust a financially shaky company with your entire financial future? A quick search for insurance company name and best rating will give you the answer in seconds. Know a rating? Cross them off the list. Now for the messy part. Real customer reviews. Go to the Better Business Bureau website, Google reviews, and other consumer sites. But you have to read these with a filter. Nobody goes online to write, "Had a perfectly adequate experience with my insurance company today." People write reviews when they're angry. So you're not looking for a spotless record. You're looking for patterns. Are all the one-star reviews about the same thing? If you see dozens of people complaining that their rates mysteriously doubled at renewal for no reason, that's a massive red flag. If you see a consistent pattern of, "They were impossible to get on the phone after my accident," or "The adjuster lowballed me and then refused to negotiate," listen to those warnings. Those are echoes of your own future frustration. On the flip side, if the negative reviews are all over the place and the positive reviews consistently mention a specific agent or a smooth claims process, that's a good sign. You're looking for the signal in the noise. Once you've vetted the companies and eliminated the ones with poor service or shaky finances, it's time to re-examine the policies themselves for hidden gotchas. This is where they hide the details that can cost you thousands. First, look for any mention of non-standard parts for repairs. Some cheaper policies will insist on using aftermarket or even salvaged parts to fix your car after a claim. A premium policy will typically use original equipment manufacturer, or OEM parts. If you drive a newer car, or you simply care about the quality of repairs, this is a huge deal. The quote page won't always advertise this, so you may need to dig into the sample policy documents or call them to ask directly. Do you use OEM parts for repairs? Next, investigate payment fees. That amazing monthly price they quoted you, is that the real price? Some companies charge a convenience fee of $5 or even $10 a month if you don't pay for the entire 6-month or 1-year policy upfront. That can add over $100 a year to your bill, potentially making a cheaper quote more expensive than a competitor who doesn't charge those fees. Then there's the issue of custom equipment. Do you have custom wheels, a high-end sound system, or any other modifications? Standard policies typically cover almost none of that. They'll cover the factory standard parts and that's it. If your $10,000 audio system gets stolen, you might get a check for $200 for the stock radio. If you have custom gear, you need to make sure the policy has an endorsement for custom parts and equipment coverage, and you need to know what the limit is. Now let's talk about a really sneaky one. Step-down liability provisions. This is a clause buried in the fine print of some policies that says if you let someone who isn't listed on your policy borrow your car, and they get into an accident, your liability coverage limits are automatically stepped down to the bare minimum required by your state. So you might be paying for $100,000 in liability coverage, but if your cousin borrows your car to go to the store and causes a major accident, the policy might only pay out $25,000, leaving you personally on the hook for the rest. If you ever let friends or family borrow your car, a policy with this clause is a ticking time bomb. After you've done this deep dive, your list of 10 quotes might have shrunk to just 2 or 3 top contenders. Now you face a final strategic choice: the human element. Do you want to deal with a faceless company through an app? Or do you want a dedicated agent you can call? There's no right answer, but it's a critical part of the decision. Going direct with a big online-only insurer can be fast, efficient, and sometimes cheaper because they have lower overhead. The downside is that you are your own agent. When you have a question or a problem, you'll likely be calling a massive call center and speaking to a different person every time. During a claim, you have to advocate for yourself. On the other hand, working with a local, independent agent can be a huge advantage. They work for you, not the insurance company. They can often access quotes from carriers you can't find online. More importantly, when you have a claim, you have a professional advocate in your corner, someone who knows the system and can fight for you. The peace of mind this provides can be worth far more than the $10 a month you might save by going direct. So here's what I recommend. Take your best online quote, then call an independent agent. Tell them, here's the best quote I found. Here are the coverages. Can you beat it? Or can you tell me why I shouldn't take it? A good agent will either find you a better deal with a comparable or superior company, or they'll be honest and tell you that you found a great deal they can't beat. Either way, you get a free expert consultation. At this point, you have it all. You have prices, you have coverage levels, you have company reputation data, and you have a sense of the service model you prefer. Lay out your top 2 or 3 options. Look at the price difference. Is Company A, with its stellar claim service and local agent, worth an extra $15 a month over Company B, the online-only provider with average reviews? For some, that answer is an easy yes. For others on a tight budget, it might be no. This is the final, personal decision. You're not just buying the cheapest product. You're making a calculated decision about risk, service, and peace of mind. You're choosing the promise you can trust when everything goes wrong. You've made your choice. You're holding the winning quote in your hand. But the game isn't over. The final step, actually purchasing the policy and setting it up correctly, is filled with its own set of last-minute pitfalls. One wrong click can undo all your hard work. So, how do you cross the finish line without stumbling? Let's start by taking a deep breath. You've done the hard work. You've navigated the labyrinth of coverages, decoded the jargon, and stared down dozens of quotes to find the one that fits you like a glove. Now you're on the final purchase page. Your cursor is hovering over the Buy Now button. This is the moment of truth, and it's where the most surprisingly costly mistakes are made. First, before you click anything, you must perform what I call the final systems check. You are the mission commander, and this policy is your spacecraft. You don't launch without checking every single dial and switch. Pull up the final quote summary and your vehicle registration side by side. Read your name out loud. Is it spelled perfectly? Even a single wrong letter can create a bureaucratic nightmare during a claim. Now look at your address. Is it exactly correct? Insurance rates are priced down to the zip code, and sometimes even the specific street. A typo here could invalidate your rate. Next, the most critical piece of data on the entire page: the vehicle identification number, or VIN. Do not assume it's correct because you used an autofill feature. Read the VIN on your screen and compare it, digit by digit, to the VIN on your registration or the driver's side door jamb of your car. I know a guy who made a one-digit error. He typed a B instead of an 8. He paid his premiums for 5 months thinking he was covered. Then he got into a fender bender. When he filed the claim, the insurance company's system couldn't find his policy because the VIN didn't match any insured vehicle. They declared the policy void from the start because he had technically been paying to insure a car that didn't exist. He was on the hook for all the damages out of pocket, all because of one single tiny typo. Check the VIN. Once the personal and vehicle details are confirmed, scroll down to the coverages. Again, don't assume. Verify. Is the bodily injury liability 100/300 just like you decided? Is your collision deductible $1,000, not $500? Is the uninsured motorist coverage stacked as you requested? This is your last chance to catch a mistake before it's locked into a legal contract. The numbers on this screen will dictate your financial reality after an accident. Treat them with the gravity they deserve. Okay, systems check complete. Now we talk about payment. You'll likely see two options: pay in full or pay monthly. The monthly option feels easier on the budget, but the pay in full option is often where the last big discount is hiding. Insurers love getting all their money up front. It reduces their administrative costs and their risk of you canceling midterm. To reward you, they often offer a significant discount, sometimes as high as 10 or even 15%. Do the math. If your annual premium is $2,000, a 10% pay-in-full discount is $200 back in your pocket. That's a free tank of gas every month for half the year. If you have the cash available, it's often one of the best risk-free returns on your money you can get. If you do choose the monthly plan, be strategic about your payment method. Do not use a debit card that's tied to a checking account you let run low. A single bounce payment can trigger a notice of cancellation. And once a policy is canceled for non-payment, it becomes a massive red flag to all other insurers, potentially raising your rates for years. Use a primary credit card, and immediately set a calendar reminder for 1 month before that card's expiration date to update your payment info with the insurer. It's a 5-minute task that can save you from a world of financial pain. Now, the most important date on the calendar: the policy effective date. This is the exact day, and sometimes even the exact minute, your new coverage begins. The golden rule is to ensure there is zero gap in coverage. Not a day, not an hour, not a second. If your old policy expires at 11:59 p.m. on Friday, your new policy must become effective at 12 a.m. on Saturday. A gap of even a few minutes means you are driving uninsured. If you get into an accident during that gap, you are 100% personally liable. The best practice is to set your new policy to become effective on the same day your old policy is set to expire. Create an overlap. So you've confirmed the details, you've selected your payment, you've set the effective date. You click the button. Congratulations! But you are not done. The first thing you need to do right now is secure your proof of insurance. The company will immediately email you a confirmation and usually a link to your temporary ID cards. Download them. Save them to your phone's files, not just in your email. Take a screenshot of them and save it as a favorite in your photo album. And then go print a physical copy and put it in your glove box. Why? Because phones die. You might be in an area with no cell service. You might get pulled over by an officer who simply prefers a physical card. Having that piece of paper is a foolproof backup that eliminates one major point of stress in an already stressful situation. With proof of your new insurance in hand, it is now time for the final critical step: formally canceling your old policy. Do not, under any circumstances, just stop paying them. That's not canceling. That's defaulting. It will wreck your insurance score and possibly your credit score when they send the bill to collections. You must actively terminate the relationship. Call the customer service number for your old insurer. Tell them, "I wish to cancel my policy, effective date of expiration." They will likely try to win you back. Be polite but firm. "Thank you, but I've already secured other coverage." Crucially, ask them 2 questions. First, Will I receive a prorated refund for any unused premium? If you paid for a full month or a 6-month term and are canceling early, you are almost always owed money back. Know that you are entitled to it. Second, can you please send me a confirmation of cancellation in writing via email? This email is your proof. It's the document that protects you if they ever claim you still owe them money. Do not hang up the phone until you have a verbal commitment that this confirmation email is on its way. The journey is almost over. Your new policy is active, your old one is canceled. What's next? The welcome packet. Whether it arrives in your inbox or your mailbox, do not ignore it. This contains your official policy declarations page, the finalized version of the quote you reviewed, and more importantly, the full policy contract. Yes, it's long and boring, but you need to file it away. Create a folder in your email or a physical folder in your filing cabinet. Label it Car Insurance. Put your declarations page, your ID cards, and the cancellation notice from your old insurer in there. This is your command center. In the chaos of an accident, you'll know exactly where every single piece of information you need is located. Finally, download your new insurer's mobile app and create your online account. Don't wait until you're standing on the side of a highway in the rain to figure out your password. Log in. Learn the interface. Find the button that says File a Claim. See where your digital ID cards are stored. Understand how to request roadside assistance. By familiarizing yourself with the tools when the stakes are low, you empower yourself to act calmly and efficiently when the stakes are high. And that's it. You've done it. You've navigated one of the most confusing and important financial decisions a person can make. You didn't just find a cheap price. You found the right protection. You didn't just click a button. You took control. You analyzed your needs, you researched your options, you compared the data, and you executed a plan. This process, this skill you've just learned is about more than just a car. It's about financial literacy. It's about protecting yourself and your family. It's about making smart decisions that compound over your lifetime. You are no longer just a driver, hoping for the best. You are the architect of your own security. And that is a feeling that no discount, no matter how big, can ever buy. Drive safe.